Tax credits for those of you families that have young kids. Oh my goodness, they've absolutely skyrocketed this year. Could be thousands of dollars of extra tax benefits for those of you that qualify. And those of you that are on the bubble, oh my goodness, you need to start doing tax planning right now to ensure that you qualify for as much benefit as possible. I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. I'm not kidding about this. There's thousands of dollars on the table for you, and this isn't like, hey, there was a proposal or the American Families Plan. If this thing passes, this is what's going to happen. No, already law. If you have young kids, your tax credits likely and potentially could increase thousands of dollars this year. And that's right, I'm talking about the tax planning that's needed if you've got youthful kids. We're talking the child tax credit has been expanded, just did a video on that, but we're going to talk about it here. But so has the child independent care credit. And so together, I mean, this is likely, if you've got a young child, then you're going to get the biggest child tax credit and could give you the most opportunity to have childcare expenses and get that enhanced credit as well. So very much these two expansions of these tax credits are connected and married. And so here's the thing though. I think there's a whole bunch of people that are going to see these credits go up this year and be excited about that. And then there's going to be a whole bunch of people that could have done something differently proactively in their finances, just made a little tweak and would have been eligible for so much more tax benefit than they otherwise would receive. So let me get into those details and explain those right now. So first is the new child tax credit. I just did a full video just on this and these new rules just a couple days ago, so check that out. But the highlights are that the new child tax credit is if you've got a child, a dependent child, younger than age 6, so age 5 or younger, your child tax credit is $3,600 if you qualify, okay? It used to be $1,000, then it became $2,000, and now it's gonna be $3,600 if you have a child younger than age 6. If you have a dependent child that's between the ages of 6 and 17, but including 17, they finally, in the tax law, are treating 17-year-olds like kids, then your child tax credit is going to be $3,000. Not $1,000, not $2,000 like it was last year. It's going to be $3,000. That is significant. So does that apply to everyone? No, you've got to have income below certain thresholds, right? And that income threshold for married filing jointly, your adjusted gross income. So that is all your incomes, that's wages, that's IRA withdrawals, that's dividends and interest and capital gains from selling your cryptos and whatever else, right? And so, but it's minus HSA contributions, minus IRA contributions, minus pre-tax 401k contributions. That is your adjusted gross income. It's before your standard deduction, okay? So if your adjusted gross income for a married couple filing jointly is below $150,000, that's your child tax credit, okay? If it's above $150,000, then it starts to phase out. It starts to taper. It starts to go down gradually until your income's high enough where your credit would be $2,000. And at that point, it stops. The phase out stops and you get $2,000 as a child tax credit, whether that child is age 16, 17, or 1 or 2, okay? There's no change depending on their age as long as they're 17 or younger, until your adjusted gross income equals $400,000 for a married couple. Then it starts tapering again until it eventually goes completely away, okay? So those are the married filing joint numbers. Cut it in half if you're single, okay? And then, cut that in half, that difference between the two if you're married, if you're head of household, all right? So that's the expanded child tax credit, okay? We'll come back to that. The second tax credit, though, that we need to talk about is the expanded child independent care credit. Did a video about this as well, but this is maybe a month ago. Here's the deal, all right? In the past, it used to be that for these children, they've got to be, younger than 13? And if you're married, both spouses, both parents, both adults in the household need to work. If one of them is not working, then you don't get any credit for paying for childcare because that other adult should be providing that childcare, okay? So you don't get any credit for that. But assuming both adults are working, if your adjusted gross income was below, get this, $15,000, that's right, $15,000, then you got a 35% tax credit on the first $3,000 you spent on childcare per child. If you had more than one kid, it was $6,000 that you got a tax credit on. So, I mean, let's think this through a second. If you've got two working adults, are you really going to have, how likely is it that your adjusted gross income is going to be below $15,000? None. That's like, thank you very little. There's no, that didn't help a lot of people. Why would you have a nice tax credit? It doesn't help a lot of people. It doesn't apply to a lot of people. So if your income was above that, your child and dependent care credit phased down to 20%, okay, 20%, but it still had those same limits of $3,000 of child care expenses for one child, $6,000 if you have multiple children. And so there again, it's like, gosh, what is this, the dark ages? No, I mean, child care, some people spend $3,000 per child per month on child care, right? And for the average person, or at least here in the Midwest, that's a couple of months. That's 2 or 3 months of full-time child care is that much. So that just, this seemed dated. Now, that's how it used to work. The new child and dependent care credit for 2021 does two different things. Number one, it moves that, the amount that you can spend per child and still get a benefit on, moves it from $3,000 per child to $8,000 per child. And for multiple kids, that instead of $6,000 is the cap, it's $16,000. So, wow, okay, that brings it into reality. Yeah, I mean, for those of you with kids in childcare, that's a meaningful number, all right? But then it moves that credit amount from 35%, but for most people it's 20%, moves it to 50%. 50% as long as married filing joint, your adjusted gross income is below $125,000, okay? If your adjusted gross income is above that, it starts phasing out until that 20% threshold, okay? So a lot of people could still see that 20% if your income's higher, could see that 20% benefit, but it's 20% on the first $8,000 for a child, $16,000 if you've got multiple kids. That's incredible, okay? So, all right, let's combine these two because like I already said, if you've got child care expenses, you likely are going to be eligible for child tax credits and vice versa, right? I mean, so these two tax credits are going to go hand in hand significantly. And let's look at a couple different scenarios. I can't break down every single possible scenario. The action item is going to be, though, I fear for the people that could be close to getting a lot from these new benefits, but don't get as much as they could simply because they didn't do some proactive planning. So I'm going to encourage you to do that, but let's dive into a couple of different scenarios. So first scenario, you're married. You've got both adults work. You've got 2 kids, age 5 and age 3, and your adjusted gross income is $100,000. In the old world, each of those kids you'd have a $2,000 child tax credit for them, so that's $4,000. And if you spent, let's say, $8,000 each on child care expenses, all right, then you'd get the maximum you could count for that of child care expenses towards that credit is $6,000, even though you spent $16,000, and the tax credit's around $1,200. So between those two tax credits, your combined tax benefits around $5,200. Okay, so that's the old scenario. That's the old world in that scenario. The new world, again, married couple with 2 kids, age 5, age 3, adjusted gross income of $100,000, and together spending $16,000 on childcare expenses. Now, your child tax credit's $3,600 per child, so that's $7,200 already. And then you qualify for the full 50% child and dependent care credit on the full $16,000 that you spent. That's another $8,000 of credit. $15,000 of tax credit in that scenario. Unbelievable. All right, second scenario. You're married, filing joint, you still have $16,000. You've got 2 kids, still have $16,000 of childcare expenses, but now those kiddos are 10 and 8, all right? And your household adjusted gross income is $200,000, all right? So because they're 6 or older, all right, your child tax credit goes from $2,000, but not to $3,600. It goes from $2,000 to $3,000 each. So instead of being $4,000 in the past, this is now $6,000 for you. Wonderful. Because your adjusted gross income is above that $125,000 threshold by a significant amount, you only get a 20% credit for your child and dependent care expenses, but it's 20% of the full $16,000. Not capped at the previous $6,000. So 20% on that full $16,000 is $3,200. So $3,200 on top of the, what was it, $6,000. So almost $9,000 in tax credits, where in the past it would have only been about $5,000. Okay. So even if your income is quite a bit above these thresholds, those limits, your tax credits are still going to be significantly enhanced because of these tax law changes. So if you followed that, what's the point? Guys, the point is a big chunk of you are going to be surprised by these new and enhanced tax credits related to having kids, okay? And your income is going to be in that 120 or 100,000 or 80,000 range, and you're going to look and say, wow, what an amazing benefit. And to you, the proactive tax planning I'd encourage you to do is start having a plan for these dollars. I mean, that could be a $15,000 tax refund for you. And I would want to make sure those dollars go towards your goals, okay? But there's nothing proactive that you necessarily need to do if you're automatically going to be below those income thresholds. For those of you that are automatically and well above those income thresholds, also be aware that, listen, you're probably going to get some increased tax credits this year. That's wonderful. Be planful with those. But if you're making $300,000 or you're making $250,000 adjusted gross income, something like that, there's not much you can do or anything you could do to really get more of these credits. You're well above those numbers. Work with your CFP to make sure you're planful. But those of you in the middle that your adjusted gross income is in that $120,000, $130,000, $140,000, $150,000. Your income right in there, you can't wait another day. You have got to work with your certified financial planner and consider what proactive tax adjustments you can make to capture, to get as much of these tax benefits as possible. For you, I fear that or for folks that you know that you don't send this video to, that aren't aware of this, they're going to get their tax return done a year from now and say, oh, wow, I didn't even know that went up. That's great. I got a bigger benefit. And just be completely unaware that they could have made a couple changes and received thousands of dollars more in benefit, okay? What are these potential changes? Well, if you knew your tax credit was going to be $10,000 more than it was previously, could you contribute more to your HSA? Well, sure, I get a tax benefit for that. And by doing that, make you eligible for more of these tax benefits. Should you shift from contributing Roth to your 401k to contributing pre-tax just for this year? Not because the Roth is a bad idea, but just because you want to get your adjusted gross income down a little bit more, as much as possible. If you knew you were going to get more tax credits to do that, you might be willing to make those adjustments. The point is, by the time you file your tax return next year, for some of these ideas to reduce your adjusted gross income, it'll be too late. You won't be able to do it. So for you or for family members or friends that you know of that might be in this range, you've got to forward them this video because they need to know some of these geeky rules, but not so that they're an expert, so they sit down with their expert and say, all right, what are the ideas? How can we take advantage of this? How can we get as much benefit as possible? So that's what I would urge you. That's what I'd encourage you to do. Work with your CFP on these rules. Your CFP has to be doing comprehensive financial planning. They can't just try to sell you investments. It's not going to help you right now. Right now, it's how do I make sure that I qualify for the maximum benefit with these changes to the child tax credit and child and dependent care credit. So work with your CFP on that. If you don't have a CFP, you can always contact one on my team. Find us online, Korhorn.com. That's Korhorn with the K, wisemoneyshow.com. You can find us there too, or just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.